reflect on, if we start at 2023, so about 12 months ago, I think we spoke about this last time, the obvious trend was a weakening Chinese domestic market. Now, what happened there, steel production actually stayed pretty robust. So whilst domestic demand for steel was falling, they were able to compensate from that with increased exports. So we can see the Chinese steel exports here on the bottom right chart of this slide. What's happened as we go into 2024 is those trends have continued. So the Chinese domestic conditions have remained weak, arguably weakened further, and actually exports of steel have increased even more. So if we were to annualise 2024 and put this on the chart, it would be higher than any of those bars in the bottom right. It would be over 100 million tonnes of exports. Now, what it feels like at this point in time is that's starting to crack. And if we look at the chart on the left-hand side here, which shows profitability of Chinese steel mills, you can see the red line, which is the year-to-date, the 2024. It's not been lower in any of these years that we have on the chart. And even the lines where it's approaching that level of profitability was during COVID in the lockdown. So it's clear that steel profitability is extremely low for Chinese steel producers. They're trying to export their way out of the issues. We're now coming up with other issues in terms of the ability for countries to take that steel, increased tariffs and the like. So it really feels like they're starting to reach a tipping point, and that's been confirmed with some of the more recent data points around steel production now in China, which is starting to fall. So what this means is for iron ore, clearly the consumption of iron ore, it's all about steel production rather than whether it's being consumed locally or in the export markets. And with that starting to crack, you have seen the iron ore price come off. So the cost curve for iron ore then becomes very important. That's the top right-hand chart on this slide. And the red line is roughly where the spot price is. It's slightly below that. And you can see that typically in a balanced market, you're looking around the 90th percentile of that chart for the intersection, which is somewhere around the $90 mark. It's currently $100. So in the short to medium term, we think for iron ore, continued soft prices. But it's important to recognise that at that kind of level of price, the BHP's, Rios, even the Fortescues to a certain extent are still very profitable. I mean, BHP in the year just gone, with an average price above $100 in fairness, generated $17 billion of EBIT, as did Rio on the same price. So even if the price is falling down to that level, they're still making good cash flows, and they are priced for that as well. Our valuations say that BHP and Rio look reasonably okay on a valuation metric, and within that, our iron ore valuations would be around 5 times that EBIT just generated. So clearly the market and ourselves are expecting those profits to fall, so there's nothing to panic about.